Good evening, all.
Good evening, sir.
All right, thank God. Please, you can mute. Our class continue. Of course, we continue from where we stopped last week. For those Zoom user, please, can you mute? For those that were in class last week, we explained financial statement analysis. We explained financial analysis as evaluation of financial statement. You are evaluating the financial statements with a view to ascertaining the financial performance of a company, as well as with a view to ascertaining the past financial performance of a company, as well as future financial prospects. This analysis enables stakeholders to know the extent to which a company has performed, whether the company is performing well or whether the company is performing poorly. It enables different stakeholders, such as the shareholders, the creditors, the investors, government, and management, to evaluate the financial performance of a particular company. We can also evaluate the future financial prospects of a company. This analysis is carried out using financial ratios. We discussed this last week. Different financial ratios, the profitability ratios that measure the profitability performance of a company. We discussed liquidity ratios, ratios that evaluate the liquidity position, the extent to which a company is liquid to finance its obligations. We discussed this. We discussed solvency ratio, that is financial risk ratio, ratios that measures the ability of a company to continue in business for a very long time. We discussed these ratios. We also discussed investors' ratios, ratios that evaluate the extent to which wealth of the shareholders, the extent to which shareholders' wealth is maximized. We discussed this. Thereafter, we look at question number 1, Osanko PSC, to explain how you can evaluate the financial state and performance of a particular company. Your evaluation, in carry out your evaluation, You may be required to do peer comparison. Peer comparison. You are comparing one company with another company. Peer. For example, we can compare the financial performance of Zenith Bank with that of First Bank. Peer comparison. You can do comparison with industry standard, where you compare a particular company against industry average, like the question we solved last week. That was comparison with industry standard. Then you can have trend analysis. A particular company, you now compare the company performance between year 1 and year 2, between year 2 and year 3, between year 3 and year 4. You are trying to look at the company's comparative financial performance for a number of selected years. That will give you trend. All right. Tonight, what page? We started this topic last week now, Matthew. This topic started last week. And that page should be page 72, 73. Sorry, page 172, 173. Okay. You can check page 171, 172, 173. All right. Now, let us look at question 2. Yes, Jane.
Hello, good evening, sir.
Yeah, good evening.
Sorry to draw your attention. Was it a previous week that we were solving one question that we didn't finish? You said when you come that last week, you continue. But last week I was sick. That's why I didn't join class. So when I was watching the video, I didn't see that people continue on that question.
I can't remember that.
The question we are solving upper Wednesday, before last week Wednesday.
What was the question? I can't remember.
Okay, maybe I'll just chat you up with the question later.
Yeah, I can't remember the question.
26 May diets. The last question.
Yes.
7.
Yes.
Which question? What topic?
That's
cost of debt. Cost of debt.
Yes, cost of debt.
Valuation thereabout. Debt valuation and that.
Valuation of debt.
Yes.
Conversion of debt.
Convertible debt.
Yeah. Stock split, something like that.
And question 7. We didn't complete it, sir. Question 7.
Me, I was not in class. That's why I didn't ask. Last week I was sick. That's why I still asked today.
Okay. What will happen is this. I will just send the solution. That was last diet question, right?
Yes, May 2026.
Yes, sir. Yes, sir.
The solution should be available. I didn't even remember. Because I got so many classes to deal with. It's okay.
Thank you, sir.
Now, please go to page 173, 174. Question number 2. Page 173, I think 174 precisely. Worry PSC. Refer to your study kits, page 174. Question 2. Please, Evelyn, can you mute?
Yes?
Evelyn, please, can you mute?
No.
Evelyn,
Oh, I'm sorry. I'm so sorry.
please mute.
All right, we move to the question. The following financial information is available for Worry PSC. You have financial information for 4 years, 2014 to 2017. You are given equity earnings. Your equity earnings is your profit after tax. Earnings belonging to equity shareholders. You have equity earnings, number of ordinary shares, price per share in kobo, dividend per share in kobo. Assume that share prices are at the last day of each year. Requirements A. Calculate Worry PSCs, earnings per share, dividend yield, dividend cover, and price earning ratio. And explain the meaning of each of these terms and states their limitation. State limitation they may have. 14 marks. This question was texted ICAN at the professional level. Now let us go to it. You have to calculate 4 ratios. Earnings per shares, dividend yield, dividend cover, price earning ratio. When you are done calculating, you are going to explain the meaning of each of these ratios and state the limitation they have. Let us go to the business. Suggested solution. Suggested solution. Let us expand this more. Let's expand the margin. Then get your calculator closer. In fact, let me get my O2 closer. Let me open my calculator to closer to me. All right. I need to calculate earnings per share. The formula is, I want to calculate in kobo. Equity earnings divided by number of ordinary shares. Then multiply your answer by 100. Now let's go to this business. Year 2014. Equity earnings, how much? 200 million. Number of ordinary shares, 2,000 million. Please divide. 200 million divided by 2,000 million. Multiply by 100. That's 10 kobo. Go to 2015. Equity earnings, 225 million. Number of ordinary shares, 2,100 million. Please calculate.
$8.7 kobo.
Let's show the workings. Multiply by 100. 10.7 kobo. I will expand this margin. Let us show the calculation. In exam, you don't need to show this calculation. No. Just pick your calculator and start computing. But for the lecturer in the classroom, to aid understanding, to enhance understanding, it is good for lecturer to show it. (2016). What is equity earnings? 205 million. You are supposed to put the question on yourself. Number of ordinary shares, 2016.
2,001 million. 2,001 million. 2,100 million.
Now calculate your equity earnings.
9.76 kobo.
9.8 kobo. Our equity earnings here, 9.8 kobo. 2017, equity earnings, 230. Is that not?
Yes, sir.
Number of ordinary shares,
1,900.
1,900 million. Multiply by 100. What is earnings per share?
12.1 kobo.
12.1 kobo. You have calculated earnings per share in kobo. Year 10 kobo. In kobo. Year 10.7 kobo. 9.8 kobo. 12.1 kobo. We are done with the calculation of equity earnings. Now, last week, we explained how to your dividend yield is calculated as dividend per divided by market price per share. multiply by 100. What is this about? Matthew, what's the problem?
Sorry, sir. I just already printed the numbers you said. I'm just joining back again. I want to know which question are you treating, sir, so I can make reference to
Question
the answer.
number 2, page 174.
Thank you, sir.
Let's go to this. So dividend yield is calculated in percentage, not kobo, not naira. Your dividend yield is a measure of actual return on shareholders' investment. All right. Dividend in 2014, 5 kobo. Share price in 2014, 220 kobo. Please divide. Five
2.27.
5 divided
Okay.
by 220 multiplied by 100. 2.3%. (2015) dividend per share 7 kobo divided by price per share 305 kobo multiplied by 100. 7 over 305 multiplied by 100. What do you have, please?
2.3, sir. 2.3.
2.3%. Please know, dividend yield is calculated in percentage. 2016, dividend per share 8 naira, 8 kobo, divided by price per share 290 kobo. Multiply your answer by 100.
2.8, sir.
0.8.
8 over 290 is 8%. I keep on repeating it. 2017, your dividend yield.
9.
Dividend 9 divided by 260.
Yes, sir.
Multiply
9 by 100.
9 over 250 by 100. What do you have?
3.5.
3.5%. Yeah. You have calculated your dividend yield in percentage. 2.3, 2.3, 2.8, 3.5. Next. Dividend cover. Your dividend cover ratio, number of times the company's distributable profits covers dividend payments. Your dividend cover. This measures the number of times the profit after tax covers the dividend payment, calculated as earnings per share divided by dividend per share. Our earnings per share, dividend per share 5 kobo. Return here. Let's expand this that we can show the workings. Let's expand this so that we can reflect the work. Please help us mute. You can enjoy your talk, but just make sure you don't complete our class. 2014. Earnings per share 10 kobo. Dividend per share 5 kobo. Our dividend cover 2 times. Earnings cover dividend 2 times. 2015. Earnings per share 10.7. Dividend per share 7 kobo. Please divide. What do you have? 1.5 times.
Yes, correct.
I have to take my calculator near me.
It's 1.5, sir.
Correct.
2016. Earnings per share 9.8 kobo. Dividend per share 8 kobo. Please divide.
1.2.
1.2 times.
1.2 times. Let us create space. All right, 2017. Earnings per share 12.1 kobo. Dividend per share. How much?
9 naira. 9.
9 kobo, not naira, please. It's in kobo.
Thank you.
9
1.3
kobo.
times.
Please divide.
1.4.
1.3 times. You have calculated your dividend cover. Calculated number of times. 2 times. 1.5 times. 1.2 times. 1.3 times. Then lastly, price earning ratio. Your price earning ratio calculated as market price per share divided by earnings per share is calculated in times. Our market value can cover earnings. Let us create space for the working. No. For 2014, the market price per share 220 kobo. Earnings per share 10 kobo. That will give me 22 times. for 2015. Market price per share 305 kobo. Earnings per share 10.7 kobo. Please divide.
28.5 times.
Thank you. Because somebody might not be in class. He's looking at what we have solved times 2016. Price per share. Earnings per share 9.8 kobo. How many times?
29.6 times.
29.6 times.
Then 2017. We need to create more space. I have to save at every interval. At every interval, I have to try to save. Because IT gadgets can be funny. 2017. Price per share 260 kobo. Earnings per share 12.1 kobo. Please divide.
21.5 times.
You can return to your calculation. $22 times, 28.5 times, 29.6 times, 21.5 times. You are done with the calculation of the selected ratios or the recommended ratios. Now, examiner says, explain the meaning of each of the ratios and tell us, state their limitation. What is earnings per share? What are the limitations of earnings per share? Now look at your material or look at your screen. Earnings per share. Earnings per share shows the amount of profit after tax. Amount of profit after tax attributable to each ordinary share. Although a high earnings per share generally indicates success, when the earnings per share is rising, it's an indication of success. Care must be taken in interpreting the trend in earnings per share. We must exercise caution when interpreting the trend in earnings per share, particularly where there have been share issues, where company issue more shares, where a company issue more shares, especially right issue at a discounted price, or where company issue bonus shares, where you issue more shares, earnings per share will fall. The fall in earnings per share is not because of performance. It's because we have issued more shares. Also, if you repurchase your shares, if ordinary shares are repurchased, number of ordinary shares will reduce. If number of ordinary shares reduced, earnings per share will rise. This does not mean that the company is doing well. Similar problems are encountered when warrants or convertible loan are issued. When a company issues convertible loan, convertible bond, the holders of the convertible bond can exercise it and convert the bond to equity. If the bond, number of ordinary shares will increase. In that, the fall in earnings per share is not due to performance problem. Those are the limitations. The rise share may not be as a result of the company's performance. So we cannot say because earnings per share is rising, the company is doing well, or because earnings per share is falling, then the company is doing badly. We cannot conclude. It is not sufficient to say that because a company's earnings per share is increasing, then the company is doing well. Or because a company earnings per share is falling. In that case, we now say the company is doing badly. Please, can you mute? Please, can we mute now? We are done with the calculation. Moses, you can mute. Thank you. Number 2, dividend yield. What is dividend yield? Dividend yield shows the ordinary dividends as a rate of return on the share value. Your dividend yield is a measure of actual return on shareholders' investment. It shows ordinary dividends as a percentage of share value. It's a measure of actual return on shareholders' investment. However, the figure is of limited use because it only shows a part of the return to shareholders. Dividend yield is of limited use. because it shows only part of the return to equity investor. What is the other return? There are two returns to equity investor. One is dividends received. Dividend received. The other is capital gain on share purchased. Let me repeat it. There are two returns to equity shareholders. If you purchase a company shares, when the company pays dividends, you are going to receive dividends. That is one return. Second is that if there is appreciation in share value, if your share price increase, for example, you purchase a share at 50 naira per share. 6 months later, the price has increased to 120 naira per share. What you purchase for 50 naira is now selling for 120. That means your investment has appreciated in value. That is called capital gain. Dividend yield ignores capital gain. It only considers dividend received. That's a limitation.
It's not here.
Madam Evening, please help us mute. Just help us mute your speaker. I'm sure she's not aware. Evening, please help us mute your speaker. Number 3, dividend cover. Our dividend cover ratio shows how many times earnings is bigger than dividend per share. The number of times your earnings covers dividend payment. A high dividend cover ratio shows that large proportion of earnings is being reinvested for growth. Let me explain that. If your dividend cover ratio is high, that means you are paying out less dividends. If your dividend cover ratio is high, it means that small percentage of your profit is paid out as dividends. A large percentage of your profits is being retained and reinvested for growth. At that point, shareholder may have concerns. If you pay out bulk of your profit as dividends, you have less for retention. That can affect your future growth. If you pay less dividend to shareholders, investor may react negatively. Now there's a problem. How do we balance it? What percentage of the company's profits are we going to pay as dividends? What percentage are we going to retain? What percentage are we going to pay that will make the investor to be happy? What percentage are we going to retain that will guarantee future growth? There's a problem. Management must decide this. And it's always conflicting. The investors want to receive higher dividends. Management want to retain most of the profit for growth and expansion. It becomes a problem getting an appropriate ratio that will satisfy all the stakeholders. The last one, price earning ratio, calculated as market price per share divided by earnings per share. This ratio shows how many times the share value is bigger than earnings per share. It relates market price per share to the earnings generated from the shares. It relates market price per share to the earnings generated from the shares. Generally, the bigger your earnings, the more the share is in demand. If a company is generating more earnings, investors will be willing to invest in your company. The ratio relates market price to earnings generated. However, care must be taken when making comparison, because earnings per share is calculated from historical results. Based on past financial results. While the market price per share is based on future expectation. Your market price is determined by the future expectation about a company. While earnings per share is calculated from your historical results. That creates a problem. The share price is affected by both risk and growth factor. What we are trying to say is the share price is determined by the stock markets. A company share price, the market share price, is determined by stock market dynamics. Most of the factors are not within the control of the company. Positively or negatively. Please note, the fact that a company share is falling does not mean the company is performing poorly. A company shares may be affected by stock market sentiment. Also, please note, the fact that a company shares is rising does not mean the company is doing very well. There are several factors that influence market share price. Most of these factors are not within the control of the company. All right. We have explained the meaning and the limitations. That's set to requirement A. Requirement B for 6 marks. Requirement B for 6 marks. Examiner say explain why the changes that occurred in the figures calculated in A above over the past 4 years might have happened. Now look at your calculation. Earnings per share in 2014, 10 kobo. 2015, 10.7 kobo. Examiner is asking you, why is it that earnings per share increased from 10 kobo to 10.7 kobo? Again, from 10.7 to 9.8, what could have happened that we make the earnings per share to fall from 10.7 kobo to 9.6 kobo? Again, check. From 9.8 to 12.1, what could have been the reasons? Examiner say we should explain why changes that occur in the figures calculated in A above over the past 4 years might have happened. Please give me 1 minute. Have it here yourself. All right, look at it. This is what we call trend. Look at your screen. Trend in 2017. Trend in 2015. Please, I will be back.
No, I can't hear anything.
He said he will be back.
He will be back.
Okay, thank you.
Go on with the class. All right. What the examiner is asking you is to explain the trend in the figures you have calculated. You are going to compare 2014 and 2015. And you are going to, there will be some calculation. Please avoid touching my screen. Your writing also involves calculations. Now let's check. Now please look at this. For me to calculate earnings per share, we use 2 variables. Our earnings per share were calculated with equity earnings over number of ordinary shares. Now, please check. Between 2014 and 2015, please, can you avoid touching my screen? Between 2014 and 2015, what is the increase in number of ordinary shares? In 2014, 2,000 million. In 2015, 2,100 million. Calculate percentage increase in number of ordinary shares. Yes, please calculate and tell me.
So what did you say? Please come again.
Can you see my screen?
Yes, sir.
In 2014, number of ordinary shares, 2,000 million. 2015, number of ordinary shares, 2,100 million. What is the percentage increase in number of ordinary shares?
5%.
5%, thank you. Number of ordinary shares increased by 5%. Now, again, go and check. Equity earnings. 2014, 200 million. 2015, 225 million. What is the percentage increase in equity earnings?
12%.
Great. 12.5, not 12%. It should be 12.5, if I'm correct. Yeah, 12.5%. Ruth, your comment, your question.
Okay, sir. Please, how is the percentage being calculated? The 5% increase and 12.5%.
How to calculate percentage increase? How to calculate percentage increase? Oh. Let me use this spacing. My pen. Leave my screen now. Now look at it. 2014, 2015, equity earnings 200, 225. Percentage increase. Percentage increase. 225 minus 200 divided by 200 multiplied by 100. We are work it out.
%12.5%. 12.5%.
Look at number of ordinary shares. Number of ordinary shares in 2014, 2,000. 2015, 2,100. Percentage increase. 2,100 minus 2,000.
100.
Divided by 2,000. Multiplied by 100.
5%.
5% increase. Is that better?
Yes, sir. Thank you.
You don't need to show this. Examiner say, explain to me what has happened. Now look at it. Trend in 2015. In 2015, share capital was increased by 5%. Probably through rights issue. That means we have issued additional shares. Most likely, the company did a rights issue. Equity earnings increased more than proportionate. Look at it. Equity earnings increased by 12.5. Ordinary shares increased by 5%. This results in 7% increase in earnings per share. How do you get that 7%? Look at this, please. Ruth, are you there?
I'm here.
Oh, yeah,
I'm here, sir.
In 2014, earnings per share 10 kobo. In 2015, earnings per share 10.7 kobo. Calculate percentage increase. Hello. I think. What is the percentage increase?
7%.
Let's calculate 7%. Why does it increase? Why do we have 7% increase? It's because equity earnings increased by 12.5. Ordinary shares increased by 5%. The increase in equity earnings minus increase in number of ordinary shares, that will give you 7.5. That explains why earnings per share increased by 7% in 2015. Let's continue. Let me save this. All right, let's continue. Resulting in 7% increase in earnings per share. An indication of successful year. It's an indication that year 2015 was a successful year. Demand for the company shares rose swiftly. There is demand for the company shares. Why is there demand? We are not sure. Either because of general stock market rise or because of high expectation of Warri PSC future. It should be Warri PSC. Warri PSC futures growth. What we are trying to explain is this. Look at share price. In 2014, 220. In 2015, 305. The company share price increased from 220 kobo to 305. What could have been the reason? We are not sure. This may be as a result of stock market rise or because of expectation, growth expectation. Investor believes that the company will experience growth at future periods. Look at it. Because of high expectation of Warri's future growth, the share price increased by approximately 40%. You can reconfirm it. 220 to 305. What is the increase in share price? Approximately 40%. The growth in share price resulted in growth in earnings per share. Look at your earnings per share. Between 2014 and 2015, price earning ratio increased from 22 times to 28.5 times. This was due to growth in the company share price. Examiner say explain why the changes in the figures. Examiner say explain why the changes in the figures you have calculated might have occurred. You are not going to go to these figures. Look at the variables for calculation. Look at the variables you have used to calculate those ratios. Let's continue. This caused a big rise in earnings per share and allowed a 40% increase in dividend per share. Go and check. In 2014, dividend per share 5 naira. In 2015, dividend per share 7 naira. What is the increase in dividend per share? 40% increase in dividend per share without change in dividend yield. The increase in dividend per share does not give rise to change in dividend yield. Check. Dividend yield in 2014, 2.3. In 2015, 2.3. Our dividend cover fell because the increase in dividends is much more than increase in earnings. Earnings increased by 12.5. Dividend increased by 40%. This resulted in fall in dividend cover. The increase in earnings is less than increase in dividend per share. Our earnings increased by 12.5%. Your earnings increased by 12.5. You now increase your dividend by 40%. Yes, please.
Najib, please mute your mic. Najib.
You might not even know, self. We are trying to explain the last aspect. Look at the dividends cover. Dividend cover reduced from 2 times to 1.5 times. What will have been the reason? The reason is because your dividend per share increased by 40% between 2014 and 2015. 5 naira to 7 naira. If you check the increase in dividend per share, that is 40%. Now check. Between 2014 and 2015, equity earnings increased by 12.5. The increase in equity earnings is less than increase in dividend per share. This resulted in fall in dividend cover ratio. an indication that more dividend is being paid out. Less retention. If you are paying more of your dividend out and you are retaining less, that can affect your future growth in earnings. Look at 2016. Look at 2016. Equity earnings reduced from 225 million to 205. Why? What could have happened? It's not impossible because the company pays more dividend in 2015. Less retention. Chioma, please mute. And I get tired. Because in 2015, we paid more dividends out than earnings generated. That means there's less retention. With less retention, that can affect our future earnings growth. When you are done with 2015, you move to 2016. What is the trend? You are going to compare 2015, 2016, and 2015. For example, in 2015, earnings per share is 10.7 kobo. In 2016, earnings per share is 9.8 kobo. What could have happened? Why did earnings per share fell from 10.7 to 9.8? Look at the reasons. Equity earnings has reduced. Number of ordinary shares remain unchanged. Automatically, earnings per share will fall. The company's profits reduced in 2016. Look at the notes. Oh. Trend in 2016. The company's earnings and earnings per share fell in 2016, either because of normal cyclical business risk or because of high dividend, because the high 2015 dividends, because we pay out higher dividend in 2015. The company is left with insufficient cash for reinvestment. earnings per share fell. Between 2015 and 2016. This may be due to normal cyclical business risks, or possibly because the high 2015 dividend left insufficient cash for investment. Your earnings are falling. Earnings per share fell. But what happened to dividend per share? Dividend per share increased from 7 kobo to 8 kobo. Despite the fact that your earnings, the company earnings fell, the company is still paying more dividend to shareholders. The company gave a bullish signal to the market. When you are experiencing fall in earnings, you are still paying more dividend to shareholders. What you are doing is what we call a bullish signals to the market by increasing its dividend per share. What you are trying to say is that the fact that my earnings is falling does not mean that this company has problem. We can still pay you more dividends. You are trying to reassure the investor that notwithstanding falling earnings, our company's future is still very bright. Look at this. Market by per share, indicating future prospects of a swift recovery and increased growth. As a result, dividend yield in spite of falling earnings, you are still paying more dividend to shareholder increase. Dividend yield increase. Although share price fell in line with earnings, demand for the company shares remain unchanged. This explains the stability in price earning ratio. I think you can look at the last one. Trend in 2027. You are going to compare 2017 with 2016. If you go check, Equity from 205 million to 230. That is 12% increase in earnings. Now check number of ordinary shares. Between 2016 and 2017, ordinary share reduced from 2,100 to 1,900. The company used some of its cash to buy back ordinary shares. Why would ordinary share reduce? The only reason is their share buyback. The company repurchased some of its shares. This is possible because it offers shareholder the choice between cash and scrip dividends. Your scrip dividend is stock dividends. Share capital reduced by 10%, resulting in big increase in earnings per share. If you check 2016, earnings per share 9.8 kobo. (2017) 12.1 kobo. This increase is due to two reasons: reduction in share capital and increase in earnings per share. Although 2017 was successful for earnings, 2017 was successful year for earnings. Demand for the company's shares fell, as shown by the share price. Share price fell from 290 to 260, and this affected price earning ratio. Why would the company share price fall? This may be as a result of share buyback. If you are buying back your shares, you are returning money back to investor. It is possible that the market has become uncertain. The stock market has become uncertain of the company's future plan. As a result of share issue and share buyback in quick succession. Let me explain that. If you check between 2014 and 2015, ordinary share increase from 2,000 to 2,100. That means the company issue more shares. Between 2016 and 2017, ordinary share reduced from 2,100 to 1,900. At one point, you issue more shares. At one point, you are buying back shares. Investors are not certain. What is the company's future plan? That affected the company's share price. Oh. That is that about that question. Any question, please?
Sir, I just wanted to make clarification. If you check the question we solved, can you hear me, sir?
I can hear you.
Okay, sir. If you check the question we solved, there is an assumption they put there. That assumption does not mean anything, right? Assume that share. The one that said assume that share prices are as at the last day of each year. Doesn't mean anything to the question.
Doesn't affect anything.
Okay, sir. All right.
Finally, we assume that the share price is at the close of the financial year. Normally, that assumption is normal. That share price is at end of 2014. So it has no impact on your analysis.
Okay, sir. Thank you, sir.
I think we are fine with 2 questions. So I think we are fine with 2 questions. All right. Financial ratio analysis. I should be going to the next topic. This is August ending. Okay. Let me allow it be. We have done trend, we have done comparison with that. Let me see. All right. Let me allow it be. Our next topic is dividend policies. If you do a recap or if you do a stock take, we have treated, on my part, we have treated We started the class with capital structure, theory of gearing. We now look at finance success. Then we move to valuation of debt securities. We now review financial statement evaluation. So we have done 4 topics. This is my number 5 topics. Dividend policy. What is this topic all about? What is dividends? Do companies need to pay dividends or not? Is dividend payment mandatory? Would dividend payments affect a company's value? What is the appropriate amount of dividends or appropriate percentage the company should pay its shareholders dividends? Dividend decision is one of the 3 key decisions that must be made by the finance manager. Dividend decision is one of the 3 key interrelated decisions that must be made by the finance manager. There are 3 key decisions. One is investment decision. The finance manager must be involved in investment decision. As a finance manager, you should be able to evaluate the financial viability of an investment. As a finance manager, you should be able to evaluate the financial viability, the financial feasibility of an investment project. That is what you do under investment appraisal. You use net present value, internal rate of return, payback period to evaluate if a project is financially viable. If you use NPV, if your NPV is positive, if the NPV is positive, we recommend that the project is financially viable. Management should undertake the project. But if the NPV is negative, we are going to recommend that the project should be rejected because that project is not financially viable. That is investment decision. The finance manager is involved. When you are done with your investment decision, if the investment is financially viable, then number 2 function, the finance manager must make financing decisions. How can we finance viable projects? How can we raise money to finance positive net present value projects? That question will be answered under financing decision. We have discussed that. How to finance business. You can finance your business with equity. You can finance your business with debt. You can finance a project with a combination of equity and debt. The finance manager must determine the appropriate method of financing that will minimize cost of finance. That question will be answered under financing decision. If you have raised finance, you now finance a viable project. Assuming we have agreed on the finance for the project, we now finance the viable project. We now generate profit. The third responsibility of the finance manager is how to distribute the profit. What percentage of the company's profits should be distributed to shareholders in the form of dividends? That question will be answered under dividend decision. Your dividends is the percentage of the company's profits that is paid to shareholders in the form of cash. Your dividend policy is the policy that determines how and how much of dividend to be paid to shareholders. There are several theories. There are many theories of dividend policy. There are many theories of dividend policy. These theories are intended to identify optimal amount of dividend. These theories are intended to identify the optimal amount of dividends a company should pay the shareholder. What is optimal amount of dividends? That amount of dividend that should be paid to shareholder that will maximize shareholders' wealth. The optimal amount of dividends is that amount of dividends that should be paid to shareholders that will maximize shareholders' investment value. There are three theories that discuss dividend policy. There are three theories that discuss dividend policy. One is the traditional theory of dividend. The first one is the traditional theory of dividends. Also known as the relevant theory of dividends. The traditional theory of dividends argues that dividend payments will have impact on companies' market value. Just 1 minute. I'm trying to do something here. All right, let's go on. Yeah, look at this. The traditional view of dividend policy is that the amount of dividend payment should be at a level that enables the company to maximize value of its shares. The dividend you are going to pay to shareholder should be at that level that enable your company to maximize value of its shares. Retained earnings contribute to earnings growth in the future. Earnings growth will contribute to dividend growth in the future. The traditional theory, also known as relevant theory of dividend, opined that the traditional theory was of the opinion that dividend is all that matters. Dividend is very important in determining share price. Companies should pay dividends regularly to shareholders. Companies should pay dividends regularly to shareholders. That is the traditional view. By paying dividend to shareholders, that will enhance the company's value. That is the position of the traditional school. They believe that dividend payments will affect value of the company. Hence, a company should pay amount of dividends that maximizes the company's value. According to the traditional theory of dividend policy, the optimal dividend policy is that dividend policy and retention policy that maximizes company share price. According to the traditional theory, the optimal dividend policy is that dividend policy that maximizes share price using dividend growth model to obtain the share price. The arguments of the traditional theory are based on the following points. The arguments for the relevant theory of dividends are premised on the following. One is dividend signals, dividend signaling. We also call it informational content of dividends. When a company pays dividend regularly, investors believe that the company is doing well. By paying dividends regularly to your shareholder, it's a means of sending signals about the company's positive performance. It is natural. If somebody is giving you money regularly, you are going to believe that that person is doing well. It is natural. What they are saying is that dividend on its own is a means of communication. Without talking, if a company pays you dividends regularly, you are going to believe that you are going to trust that company. So there's informational content of dividends. In reality, investors do not have perfect information concerning the future prospects of a company. Dividend payments provide information about a company's future prospects. That is number one reason to support traditional theory of dividend. Number two reason, preference for current income. There's preference for current income. Many investors require cash dividends. They will prefer to receive their return in the form of cash dividends. Many shareholders will prefer companies to pay them cash dividends regularly. There's preference for current income. Let me receive my return in the form of cash every year. Investor will have preference for current income. Number 3 reason to support traditional school. Dividend payments is a resolution of uncertainty. When a company pays dividends regularly to the shareholder, that resolves uncertainty surrounding capital growth. One argument often put forward for high dividend payouts is that income in the form of dividends is more secured than income in the form of capital growth or capital gain. One argument often put forward for high dividend payouts is that income in the form of dividends is more secured than the income in the form of capital gain. Investors place more value on high dividend payout shares. That is, investors will prefer companies that pays out dividends resolution of uncertainty is sometimes called a bird in the hand theory. A bird in the hand. Return received in the form of cash dividend is better than capital appreciation, growth in share price. Number 4, taxation. In many situations, income in the form of dividend is taxed in a different way from income in the form of capital gain. This distortion in the personal tax system can have impact on investors' preference. Some investors may prefer capital gain. Some may prefer dividend received. because of taxation. Some investors will prefer to receive their return in the form of cash dividend. These are the arguments supporting the traditional theory of capital of dividend policy. We are done with the first theory. Number 2 theory, Modigliani and Miller theory. Modigliani and Miller, dividend irrelevant theory. Modigliani and Miller, dividend irrelevant theory. Modigliani and Miller developed a theory of dividends to suggest that dividend policy is not relevant. Dividend policy is irrelevant. And the level of dividend paid, level of dividend payout by a company does not matter. Modigliani and Miller develop a theory to suggest that dividend policy is not relevant. And the level of dividend payments, level of dividend payouts by a company does not matter. The total market value of a company will be the same regardless of the amount paid as dividends. Total market value of a company will be the same regardless of whether dividend payout is 100% or 0%. MMM argued that dividend policy is irrelevant. It does not matter the amount you pay as dividend. Company market value will not be affected. According to Modigliani and Miller, dividend policy of a company will not affect the company's market value. The amount paid as dividends does not have impact on the company's market value. This theory was developed upon certain assumptions. The MMM theory was developed upon certain assumptions. One, The theory assumes that there is no taxation. The theory assumes that taxation is zero. To M&M, the amount paid as dividend, if you like, pay 100% of your profit as dividend. If you like, pay 50% of your profit as dividend. If you like, don't pay dividend at all. Value of the company remain unaffected, provided there is no taxation. Tax is assumed to be zero. Earnings power matters, not dividends. They argue that what determines companies' market value is the earnings potential, ability to generate more earnings. Companies' value is not affected by dividend policy. Modigliani and Miller argues that if a company has opportunities for investing capital projects with a positive NPV, the company can decide to use its retained earnings to finance the investment, or you can decide to obtain equity, issue more equity to finance the project. We can issue more equity to finance the project. By issuing more shares, there is no issue cost. However, if you look at M&M, most of the assumptions are unrealistic. M&M assume that company will not pay tax. In reality, the investor will pay price, will pay tax. To M&M, if a company is not paying dividends, then the money must be reinvested in viable projects. So to M&M, if you like, pay dividends. If you like, don't pay dividends. That will not affect your market value. If you are not paying dividends, you must invest in viable projects. All right. What other things? The major problem with M&M is from its assumption. Wow. Number 3, residual policy of dividends. Residual policy of dividend is that an optimal amount of dividend should be decided as follows. The residual policy says there's optimal amount of dividends a company should pay. Should be this. One, if a company has capital investment opportunity with positive NPVs, then the company should invest in such projects. Because by investing in positive NPV projects, that will increase value of the company. The capital to invest should be obtained internally. You are going to start from retained earnings. When you are done with retained earnings, you now move to capital, debt finance. The amount of dividend paid by a company should be the residual amount of earnings remaining after all viable projects has been financed from retained earnings. Dividend payment is treated as a residual decision. A company will only pay dividends after you have financed all viable projects from your retained earnings. The balance will now be used for dividend payment. By following this order, we can maximize, we can get to optimal dividend policy That's residual policy. Let me round up here. Your dividend capacity. Dividend capacity can be defined as ability of a company to pay dividends at any given time. Dividend capacity measures ability of a company at any given time of the firms to pay dividend to its shareholders. Dividend capacity have a direct impact on the company's ability to implement a dividend policy. Dividend capacity is the amount of distributable profits a company has for dividend payments. Legally, the firm's dividend capacity is determined by the amount of accumulated distributable profits. Let me round up with this. Factors that influence dividend policy. Factors that have impact on the company's dividend policy. One, legal position. Legally, the firm dividend capacity is determined by the amount of accumulated distributable profits. Your distributable profits will affect your dividend policy. If your distributable profit is higher, accumulated distributable profits, you can pay more dividends. Number two factor, level of profitability. Profit is obviously an essential requirement for dividends. All things being equal, the more stable the profit of a company, the greater the percentage that can be paid as dividends. If a company profit is stable, stability of earnings will affect dividend policy. And please note, it is not mandatory for companies to pay dividends. Dividend payments is at the discretion of the company's director. Director may decide to pay dividends or not to pay. Growth potential. A rapidly growing company will pay less dividends If your company is just growing, you prefer to plug back, reinvest most of your profits to sustain the growth. If a company is just growing, rapidly growing, commonly pay very low dividends, the bulk of the earnings will be retained and reinvested to finance the expansion. Control issue. Control implication. To preserve ownership and control. Management can decide to pay less dividend and retain bulk of the profits to finance projects. Number 5, liquidity and cash flow management. When a company is sufficiently liquid, it can easily pay higher dividends. Wow, 6 minutes after. Lastly, taxation. The personal tax position of investor may put them in a position of preferring either dividend income or capital gain through growth in share price. Taxation will have impact on dividends. If the tax rate is high, that will reduce profit available for distribution. I think we should stop here.